What's up, guys? I hope you're doing well. James here from jamesdforsythe.com. So I wanted to continue on, and I'm still researching more about how stablecoins and that sort of thing are kind of competing with the possibility of a central bank digital currency, right? And so I've done a few videos in the past, or quite recently actually, about basically mostly Fed Governor Christopher Waller. He seems to be at least the most outspoken against CBDCs. Especially from the Federal Reserve. And so I found one of his old speeches from November of last year. So it's November 17th, 2021 was when this speech was given. It's basically him reflecting on stablecoins and other payment innovations. And basically, since he's been the most outspoken against them, I kind of wanted to go more into his point of view because I've already gone through Lil Brainerd's a bunch. So which holds the opposite opinion, I guess who holds the opposite opinion. And then basically, I also found, I like going through the sources and stuff, and basically finding some of the things that he cites. Like he cited a president's working paper, or the president's working group, I believe is what it's called. And they made a report on stablecoins, but has quite interesting opinions in this respect of how stablecoins are basically the private version of a CBDC. Right, so basically, if I'll just get more into it with his words and such, so that it kind of makes more sense, and I don't want to put words in his mouth. So basically, citing him, his skepticism about the need for a CBDC, which he still holds, comes in part from the real and rapid innovation taking place in payments. His argument, as simple as it sounds, is that payments innovation and the competition it brings is good for consumers. So basically, he says stable coins are a type of digital asset designed to maintain a stable value relative to a national currency or other reference assets. So stable coins have piggybacked off the recent increase in the crypto asset activity, and their market cap has increased almost fivefold in just the past year. And that fivefold statistic is cited from the President's Working Group paper. Okay? And so basically says these stablecoins can come in two forms. Basically, some serve as a safe and liquid asset in the decentralized finance or DeFi world of crypto trading. And then examples include Tether and USD Coin, which if you're familiar with crypto, I'm not really going to go too far into those because I'm not a huge crypto guy. But I just think the whole CBDC argument is kind of what I'm more interested in, I'll say. So alternatively, there are some stable coins that are intended to serve as an instrument for retail payments between consumers and firms. So although these types of stable coins have not taken off yet, some firms are working to assess the viability of such stable coins as a retail payment instrument. And this is kind of his main focus is these stable coins that would be used for retail payments, because basically he makes them or argues that they're analogous to bank deposits, right? And draws a lot of possible uses that are identical, as he says. And then basically, not only that, but it kind of follows on the whole thing you hear them touting a lot, them being Federal Reserve, or I guess FOMC members. Basically, the whole concept of like same use, same regulation. So kind of drawing parallels between the new kind of DeFi or crypto type assets and traditional financial assets, and basically saying, hey, if they have the same use, they should follow the same regulations. Not necessarily the same code, but the same concepts of regulations. I guess going into the whole kind of the spirit of the law sort of thing. And the laws that regulate both sets for both systems should have the same spirit. So that being said, so he says this growth in the usage of stablecoins and their potential to serve as a retail payment instrument has prompted regulatory attention, including a new report from the President's Working Group on Financial Markets, like I've brought up a few times already. This report urges that Congress to limit the issuance of payment stablecoins to banks and other insured depository institutions, basically making it another form of commercial bank deposit, but not a liability of the commercial banks, it doesn't seem, because it seems like he still wants them to be private stablecoins, but we'll kind of articulate his argument further as we go on. So basically he says that this is the perfect time to debate it. It's necessary, and it is important to get everything right that they can, and says if they don't, that these technologies may move to other jurisdictions, which would pose a risk to U.S. markets that we will be much less able to manage. Right? It's basically before it goes somewhere else, take care of it now, sort of thing. So he says stablecoin arrangements involve a range of legal and operational structures across a range of distributed ledger networks, and they are a genuinely new product based on genuinely new technology. But despite the jargon surrounding stablecoins, we can also understand them as a new version of something older and more familiar, the bank deposit, drawing that analogy between stablecoins and bank deposits. And basically elaborating more on the whole kind of dynamic and why he's drawing this kind of analogy. He says commercial bank money is a form of private debt, the whole debt is money thing. And we know this because commercial bank money, your checking deposits or savings deposits, whatever you have at your bank, demand or time deposits, they're liabilities of your commercial bank, and they show up on the liability side of their balance sheet, right? Asset side of yours, right? And so they owe you that money. And so the bank issuing that debt, the deposits, promises to honor it at a fixed 1-to-1 exchange rate with central bank money, right? Basically cash. For the public, this is cash. Basically that you can withdraw cash, transferring the commercial bank liability into a central bank liability, right? And so the bank itself is responsible for keeping that promise. However, the bank is supported in the task by a tried and true system of public support. And basically, the regulation and supervision that they have, the availability of the discount window is another example he gives, basically public support for it, basically ensuring that well-capitalized banks can still meet their, as he says, emergency liquidity needs. And then also deposit insurance, FDIC insurance, the whole $250,000 limit. And then for credit unions, it is the NCUA. I don't know if it's the same kind of dynamic or if it's just the same limit between the banks and the credit unions on exactly how that is from the credit union side of things. But regardless. So, and basically he says like this whole kind of dynamic with bank deposits, right? How they function and the banks being able to transfer their liabilities into central bank money for their depositors, right? He says this has many advantages and includes small retail customers do not have to spend their time vetting the safety and soundness of their banks. Regulators and supervisors do that for them through the regulations and stuff that the banks all have to deal with. And so consumers have a safe place to keep their savings and a nearly risk-free way to make payments, which are settled in ultra-safe central bank liabilities, bank reserves, right? So banks can focus their efforts on investments, products, and services from a place of safety and soundness. Communities and customers benefit from those efforts in the form of more efficient capital allocation and higher quality, lower cost financial products. I'm not going to go into the whole argument on the safety and soundness of the investments and all that kind of banking stuff, because that's a big rabbit hole that's not the purpose of the speech, right? We're basically just trying to continue to draw advantages and disadvantages and kind of showing the analogy between the stablecoins and the bank deposits. It seems specifically with respect to stablecoins used for retail payment. Most kind of drawing off of his argument and kind of discussing it as we go. And so he says the objective of stablecoins is to mimic the safe asset features of commercial bank money. Basically, the stablecoins, by staying 1-to-1 kind of with the US dollar, for those pegged to the US dollar, pegged being kind of a loose term, just to show the concept. The whole point is that they act like commercial bank money in a different form. So they typically offer a fixed exchange rate of 1-to-1 to a single asset or a basket of assets. Payment stablecoins tend to choose a sovereign currency as their anchor, typically the US dollar, which is where I'm drawing that kind of analogy. So stablecoin issuers suggest that one can redeem a stablecoin from the issuer for $1, although redemption rights are not always well defined, nor is the entity responsible for conducting redemption always clearly specified, things that you do have with commercial banks. And this is kind of where the whole argument for same use, same regulations kind of come in, right? And so he says to enhance the credibility of redemption at par, some stablecoin issuers go further, promising to limit the investments they make with the money backing each stablecoin by keeping it in cash or other highly liquid assets. We're not going to go into some of the stuff that's been happening with stablecoins in the, I guess, not so near past anymore. I think it's been a couple months since we had those kind of blow-ups for the stablecoins and that sort of thing. But regardless, not trying to get ahead of myself. So, in this respect, stablecoins can resemble a narrow bank, in quotes, a well-known payment-only banking structure that monetary economists have studied for more than half a century. Gives another citations to the president's working paper. Constructed this way, stablecoins also resemble currency boards, which peg a foreign currency to the dollar and hold dollar reserves to back up redemption promises. So it seems like he's not only drawing these stablecoins to be analogous to commercial bank deposits, but also to foreign currencies that are pegged to the US dollar. Maybe not so much in structure, well, obviously not so much in structure, but more of an application. They're kind of analogous in how they'd be used and how they kind of behave. It seems to be his argument. So, stablecoins help fill that gap as a less volatile anchor for crypto asset transactions and on-ramp for digital asset trading. Basically saying, he goes into how commercial bank money is not really, as he says, native to public blockchains, and that these distributed networks that support trading and other activities involving crypto assets. So basically the stablecoins are kind of, again, drawing the analogy between stablecoins and the commercial bank deposits, how they're kind of fulfilling the same functions. It's just one's in the whole digital asset trading and the other one's in, I guess, traditional trading, if you want to think of it that way. So basically, he says this kind of role that these stablecoins are playing, he says as a more stable private asset in digital markets that otherwise lack such assets, it has meaningful benefits in and of itself. So helping make those markets deeper and more liquid, right? The whole purpose of having a tradable market. And so a well-designed, well-regulated stablecoin could also have other benefits, which go well beyond digital asset markets. So it might allow for different activity on distributed ledger technology or DLT platforms, like a wider range of automated or smart contracts, which that's more of me just quoting him for you guys that are more well acquainted with the whole crypto trading and that sort of thing. I am not, so I'm not going to go that far in depth with it. I'm not going to go in any depth with it besides just saying what he said at that point. But to go further, so it might serve as an atomic, in quotes, settlement asset and thus help bring some of the speed and potential efficiencies of digital asset markets into more traditional ones. So with the right network design, stablecoins might help deliver faster, more efficient retail payments as well, especially in the cross-border context, where transparency can still be low and costs can still be high, right? So kind of drawing the whole analogy between the cross-border payments problem that we've had come up with CBDCs quite a lot. That is a major selling point for central bank digital currencies, is whether or not they would help fix cross-border payments. And then you get into the whole argument of interoperability, that they have to work between the different systems, not only just monetary, but also legal and that sort of thing as well, right? Everything that kind of will come along with foreign trade, I guess. Right? And basically saying maybe these stable coins can also be used for that, for the foreign trade between those systems, if it fills those same characteristics. It's just, it's no longer a centralized, it's not controlled by a central entity like a central bank digital currency would be. It would be more of a private sort of function, depending on however it's structured. I guess with the stable coins, it really just depends if it's like a company thing or if it's kind of like a more objective token in and of itself. I know there's a bunch of different ones, but I'm not going to go, like I said, I haven't studied every single stable coin out there or even a few. It's just kind of looking more at the CBDC argument and bringing in stablecoins into that kind of concept itself. So he says to capture those benefits, stablecoins must bridge the biggest gap between them and commercial bank money, which is, as he says, robust, consistent supervision and regulation and appropriate public backstops, right? Basically, again, how did I draw a blank? The whole same use, same regulation, basically having a parallel system in and of itself, whether that be other private companies work that way with the stablecoins, or if the government comes in and does it, or some government entity or whatever does it as they do with like the commercial banks or whatever it happens to be. Like, I guess basically, should stablecoins have their own version of the FDIC as an example, right? And things like that. And he brings up, let's see, strong oversight combined with deposit insurance, like the FDIC kind of analogy, and other public support that comes with it is what makes bank deposits an acceptable and accepted form of money. Today, stablecoins lack that oversight, and its absence does create risks. And he gives three major risks that go much more in depth in the President's Working Group paper that I'll go through probably in the next few videos and kind of elaborate more on those as I go through that one as well. But just to kind of bring up three of those risks that are discussed. One is destabilizing runs, your classic bank run, just basically on a stablecoin instead. That's pretty much all that is. And so the second one would be like a payment system failure. So basically how the regulations are in terms of the payment system, how it functions, that sort of thing, and basically having set standards for that sort of, for stable coins and how they are with retail payments as we do for commercial banks and that payment structure. And then also the risk of scale, and basically gets into the whole, like, you know, the interoperability argument and network effects. So the idea of network effects basically being the more people that use one payment instrument or one form of currency, the more kind of useful it is, the greater value it has to each participant, because they can trade and transact with that many more people, and it creates a much larger network, right? And so basically he talks about that, but looks at it in the form of the stable coins themselves. So like if you have a bunch of, it's important to have, let me rephrase that and try to articulate it better. He argues the point for ample competition by having many different types of stablecoins and different competitors, like different currencies that you see in like Forex and stuff. Like all the countries and their different currencies, that sort of thing, just with stablecoins. And this is as opposed to actual like one stablecoin that has kind of monopoly power over the entire payment system. Even though that monopoly power would maximize interoperability throughout the entire system, that lack of competition, he argues, would basically be a net negative for consumers, because it would basically, see if I can find his exact words, at least quickly, maybe not. It was basically like if you allow this type of monopoly power, here it goes, you give the ability to extract rents in exchange for access, which again hurts competition and decreases the network benefits to consumers, right? So keeping that in mind. And so, excuse me. And so, let's see, looking beyond the banking model and kind of just how would this be modeled in real life in general. So restricting the issuance of these payment type stablecoins to insured depository institutions like commercial banks or other depository institutions, and imposing strict limits on the behavior for wallet providers, basically the digital wallets that actually you use to use the stablecoins and other crypto. And so basically, given the economic similarities between payment stablecoins and bank deposits, he has no objection to the idea of banks using both instruments, so banks also having stablecoins. And then he says the United States has a tried and true system, again, for overseeing and supporting the creation of commercial bank money. And there's no reason to suggest it could not be adapted to work in this context. He says, however, he does disagree with the notion that stablecoin issuance can and should only be conducted by banks. Again, the whole competition thing. And he says this is simply because of the nature of the liability. So he says he understands the attraction of forcing a new product into an old familiar structure, forcing this new product of stablecoins to only be allowed, for banks to be the only ones to be allowed to use it or issue it, right? He says, but that approach and mindset would eliminate the key benefit of a stablecoin arrangement, which basically that it serves as a viable competitor to banking organizations in their role as payment providers. Basically, the stablecoins in and of themselves act as a competitor to the entire commercial banking system. That's kind of his point, it seems. So basically, if you have it so that only banks can issue stablecoins, you completely defeat the purpose of the stablecoins in general, and you might as well just have bank deposits. It makes it pointless. Whereas it's okay to allow banks to also have stablecoins or also issue stablecoins, but they can't have a monopoly upon that issuance. There has to be other outside of the commercial banking system, non-bank entities who are allowed to issue private stablecoins, it seems, right? So, let's see. I'm trying to make sure I don't have any. Yeah, basically they just need to. This brings up a new questions for the discussion, the typical things that you see with the Federal Reserve. We need more data, we need more research, that sort of thing that you have with this in general. So he says there are new questions to consider, such as around the use of consumers' financial transaction data, but where anti-competitive behavior happens, existing law, and particularly antitrust law, should still apply. So kind of your over-encompassing, I guess, objective laws in terms of the payment structure and payment systems should still apply, but maybe just tweak or add different ones that are analogous to the traditional banking system, but apply to crypto and stablecoins, sort of thing. At least that seems to be his argument. So, with that being said, that is the end of the speech. At least me using it as notes, I guess. And I will basically, as always, it'll be linked in the description. I always put sources in there because that's always been a pet peeve of mine when people use information and don't put sources in there. And I know this is kind of a newer format because of the current situation in terms of not having it as a screen share, but towards just a speech, it didn't seem like it really mattered all too much. That, and I know the videos on here are a lot better quality, and I haven't figured out how to do the screen share thing yet since it's on my phone. It is what it is. But regardless, audio and video should probably be, I'd hope it would be better. It takes a lot longer to upload, but that's kind of me just ranting about other things. But yeah, to conclude, everything will be in the description. As always, to find it, please feel free to discuss and tear apart or comment, whatever happens to be. That's the whole point of these videos, is to kind of get the information out there. I'm kind of thinking through it, trying to understand it. I love the discussion aspect of it. The whole point is knowledge is a circle, is the way I think about it. It's like you have to, there's not really two sides to an argument anymore. If you really think about it, and if you really study like a specific topic or argument long enough and hard enough and truly understand it, you kind of see to where it seems like all the opinions kind of circle around to kind of, it's more of a spectrum of things, which is why I enjoy putting out the videos and that sort of thing, so that it can kind of get the different skepticisms, the criticisms, and maybe the opposite as well. But anyways, I'm going to leave this one here. So I hope you guys have a good night, and I'll see you on the next one.